The investment advice most people receive is technically correct, but incomplete. It teaches compound interest as something that works in your favor. Patient savings, time in the market, the exponential growth curve. That picture is accurate, but it is only half the picture. The same mathematical mechanism operates on every financial product you touch, including the ones you owe money on. This tutorial is about the half you were not shown, and why understanding it changes the order in which you should make every financial decision from this point forward. This tutorial is aimed at working professionals, typically in their 20s or 30s, who are earning, potentially saving, and also carrying some form of debt. Student loans, a mortgage, perhaps a car payment, or a credit card balance. For most people in this situation, compound interest is not primarily working in their favor. It is primarily being paid to lenders. That is not a moral failing. It is the predictable structural outcome of how the economy is arranged, and it is a solvable problem once you understand the mechanism clearly. The standard teaching goes like this: invest early, leave it alone, and time does the work. The graph goes up and to the right, exponentially. This is true, but this framing treats compound interest as a feature of savings products, something that only operates inside investment accounts. It does not. Compound interest operates on every financial product you touch: your savings account, your brokerage account, your credit card, your car loan, your student loan, your mortgage. Whether it is working for you or against you depends entirely on which side of the transaction you are sitting on. Compound interest has a simple definition: earning returns on your returns or paying interest on your interest. When you invest, your gains generate their own gains. When you borrow, your unpaid interest generates its own interest. The word compound means the base keeps growing, so each period's interest is calculated on a larger number than the period before. This is why the growth curve is exponential, not linear. And this is why the mechanism produces results that surprise people. The human brain thinks in straight lines. Compound interest moves in curves. That gap is where most financial mistakes live. The most important variable in compound interest is not the rate. It is time, and specifically early time. A dollar invested at 25 does not do twice the work of a dollar invested at 35. Depending on the return, it does roughly 3 times the work. The reason is that early years have more doubling periods ahead of them. Each doubling doubles everything that came before it. So the first decade of your investing life is worth more than the next 3 combined. 2 people investing the same annual amount, but starting 10 years apart, will end up with dramatically different balances at retirement, even if the later investor never stops contributing. Rate matters, but it receives far more attention than it deserves relative to time. A lot of energy goes into comparing fund choices, chasing yield, and debating asset allocation percentages. These are not worthless exercises, but they are secondary. Optimizing your rate while ignoring time is like training for a marathon by buying better shoes while sleeping 4 hours a night. The difference between a 6% and an 8% return over 40 years is significant. The difference between starting at 22 and starting at 32 is more significant. And the difference between carrying high-rate debt and eliminating it dwarfs both of those comparisons entirely. Here is the concept that changes how you see your entire financial picture. Debt is compound interest running in the opposite direction. When you carry a balance on a loan or credit card, the lender earns compound interest on your debt. The interest they charge compounds over time, just as your investment returns would compound over time. The mechanisms are mathematically identical. The only difference is the direction of the transfer. In an investment, compound interest moves wealth from the market toward you. In a debt, it moves wealth from your future earnings toward the lender. Understanding this symmetry is the foundation of thinking clearly about your real financial position. Credit card debt is the most expensive compound interest most people carry. A typical credit card charges between 20% and 30% annual interest, compounding monthly. At 22%, a balance of £5,000 left unpaid, with only minimum payments made, will take well over a decade to clear and cost close to double the original balance in total. That 22% does not pause when the market falls. It does not offer a tax advantage. It does not care about your intentions. It is a continuous, guaranteed transfer of your future income to the lender, and every month the balance persists, the total cost rises. Student loans feel manageable in isolation because the monthly payment is often modest relative to income. But run the full calculation and the picture changes. A £40,000 loan at 6.8% interest over 20 years involves total repayments of approximately £75,000. You borrowed $40,000. You returned $75,000. The extra £35,000 did not fund your degree. It was paid in interest, compounding over 2 decades, transferred to a lender. The key insight here is that total cost is not simply rate multiplied by principal. It is rate compounding over time, and the longer the term, the more disproportionate the total cost becomes relative to the original amount borrowed. A mortgage is the largest compound interest event most people will ever be involved in. A £400,000 mortgage at 6.5% over 30 years involves total repayments of approximately £910,000. You are purchasing a £400,000 property for $910,000. The difference, £510,000, is compound interest paid to a bank over 3 decades. The cultural framing around mortgages, building equity, and investing in your future is not wrong exactly. The equity you build is real. So is the £500,000 flowing in the opposite direction simultaneously. Both things are true at the same time. The net compound interest position is a calculation almost no one does, and it is the most important number in your personal finances. The idea is straightforward. Add up everything compounding in your favor: investment accounts, savings generating interest, any assets generating returns. Then add up everything compounding against you, every debt, at its current interest rate and balance. The difference between these two figures is your net compound interest position. If the number is positive, compound interest is, on balance, working for you. If the number is negative, which it is for a significant proportion of people under 40, compound interest is primarily working for your lenders, not for you. For most working professionals under 40, the net compound interest position is negative. This is not a personal failure. It is the predictable outcome of how the economy is structured. Higher education is increasingly debt-funded, housing requires a mortgage, and consumer credit is marketed aggressively from the moment you have an income. The interest rates on common debts, credit cards at 20 to 22%, student loans at 6 to 7%, car finance at 8 to 12%, frequently exceed the expected return on standard investment portfolios, which average around 7 to 9% annually. Many people are losing more to compound interest than they are gaining from it, even while actively investing every month. Here is the calculation that makes the debt-first argument concrete. Paying off a 22% credit card is a guaranteed 22% return. There is no equivalent guarantee available anywhere in the investment market. The expected return on a diversified equity portfolio is around 7 to 9% annually, and that is an average, not a promise. There will be years when the market falls 20% or more. The credit card charges 22% regardless of market conditions. A certain 22% beats a probable 9% every time. From a pure compound interest perspective, eliminating the highest rate debt before making additional investments is the mathematically sound decision, because the return is both higher and certain. Sequence matters more than the specific instruments you choose inside your financial strategy. The debate about index funds versus bonds, or which ISA to prioritize, is a secondary conversation. The more important question is, are you at a net positive compound interest position yet? Getting there, where your assets compound faster than your liabilities, is the structural goal. A person who clears their credit card debt and starts investing in a basic index fund has done more financially useful work than one who spends 3 years researching optimal asset allocation while carrying a revolving credit card balance. Optimize the order of operations first. Optimize the instruments once the structural problem is solved. The most common mistake is treating investing and debt repayment as separate, independent decisions and defaulting to invest as much as possible as early as possible without examining the debt side of the equation. The logic feels reasonable. Time and market matters. That is true, but the debt is also compounding with time. If your debt costs 22% and your investments return 7 to 9%, you are losing the spread every single month. The net effect of investing £500 per month while carrying a £5,000 credit card balance at 22% is negative. You are going backwards in net compound interest terms, even while your brokerage account shows a growing number. What good looks like is a clear sequence. First, eliminate credit card debt and any other high-rate debt. Anything above roughly 8 to 10% where the debt rate clearly exceeds expected investment returns. Second, build a small emergency reserve, roughly 3 months of essential expenses. The purpose of this reserve is not to generate returns. It is to reduce the probability that a cash flow shock forces you back into high-rate debt. Third, Begin investing systematically. At this point, compound interest is aligned with your interests rather than against them. You may still carry a mortgage, and the decision of whether to overpay versus invest is a genuine trade-off. But the most urgent version of the problem is solved. The first action step is to run the net compound interest calculation. This means writing down every debt you carry, credit cards, student loans, car finance, mortgage, with the current balance and annual interest rate. Then write down every asset generating returns, investment accounts, savings accounts with their rates. Multiply each balance by its rate to get the annual cost or annual gain. Sum the gains, sum the costs. The difference is your net compound interest position. This is a 5-minute exercise. It is not complicated, but it is one most people have never done. And doing it once gives you a clearer picture of your real financial situation than years of vague awareness. The second action step is to target your highest rate debt first. In personal finance, this is sometimes called the avalanche method, and the mathematical case for it is clear. The highest rate debt extracts the most from you per pound of balance. Every pound you direct at it eliminates a guaranteed return equal to the debt rate. Write your debts in descending order by interest rate. Make minimum payments on everything else. Direct all available surplus cash to the top of the list. When that debt is cleared, move to the next. The measurable outcome is straightforward. Your net compound interest position improves with every single payment, and the improvement accelerates as high-rate balances fall. The third action step is to build the emergency buffer before you begin investing in earnest. The reason this step matters is that progress on debt elimination is reversible. A car repair, a medical bill, a gap in employment. Any unexpected expense that exceeds your available cash will likely land on a credit card, resetting the work you have done. A reserve of roughly 3 months of essential expenses is not a high-return asset. It is insurance. It protects the compound interest position you have built. Once it is in place, begin investing systematically. At that point, the hockey stick graph describes your trajectory, not your bank's. Everything covered in this tutorial, the bilateral mechanism, the net position calculation, the sequence argument, the mortgage arithmetic, the cognitive reasons compound interest is consistently misunderstood, is laid out in full in the article on realsyllabus.com. The article goes further on why the financial industry has limited incentive to present the complete picture, what the correct mental model demands of you in practice, and how to think about the genuine trade-offs that arise once you are at a net positive position. If this tutorial was useful, the article is the long-form version worth reading in full. The link is in the description.